Welcome to our channel. Today, we're delving into the intricacies of asset allocation, a crucial concept for any investor seeking to build a robust portfolio. Whether you're a beginner or an experienced investor, understanding how to distribute your investments across various asset classes is key to achieving your financial goals. Asset allocation is the strategic distribution of investments across different asset classes, such as stocks, bonds, real estate, and cash equivalents. The primary goal is to create a diversified portfolio that balances risk and return based on an individual's investment objectives, risk tolerance, and time horizon. Importance of asset allocation: risk management. Proper asset allocation spreads risk across different investments, reducing the impact of volatility in any single asset class. Maximizing returns. By diversifying, investors can capitalize on the performance of different asset classes, potentially increasing overall returns. Alignment with goals. Asset allocation allows investors to align their portfolios with their specific financial goals, whether it's retirement planning, wealth preservation, or growth. Certainly. Here's a breakdown of the significance of asset allocation. Importance of asset allocation. Asset allocation stands as a cornerstone in the world of investing for several reasons. Risk mitigation. By spreading investments across different asset classes, asset allocation helps manage and mitigate risks. This diversification minimizes the impact of any single asset's poor performance on the entire portfolio. Enhanced returns. A well-diversified portfolio allows investors to capitalize on the performance of various assets. During different market conditions, certain assets may perform better than others, potentially boosting overall returns. Alignment with objectives. Each investor has unique financial goals and risk tolerance levels. Asset allocation enables the alignment of investment strategies with these goals, whether it's capital growth, income generation, or wealth preservation. Long-term stability. A properly allocated portfolio can offer stability during market fluctuations, helping investors stay the course and avoid knee-jerk reactions to short-term volatility. Adaptability. As an investor's circumstances change or as markets evolve, asset allocation provides the flexibility to adjust the portfolio to meet new goals or adapt to shifting market conditions. Psychological comfort. Knowing that investments are diversified across various assets can provide peace of mind, reducing anxiety associated with market uncertainties. In essence, asset allocation serves as a strategic tool that not only balances risk and return, but also empowers investors to navigate the complex world of investments with confidence and resilience. Strategies for asset allocation. Age-based allocation. This strategy suggests that younger investors with longer investment horizons can afford to take more risks, allocating a higher percentage to stocks. As investors age, they may shift towards more conservative assets like bonds. Risk tolerance approach. Investors assess their risk tolerance and allocate assets accordingly. Those comfortable with higher risk may allocate more to stocks, while those with lower risk tolerance might lean towards bonds and other fixed income assets. Diversification. Spreading investments across various asset classes, industries, and geographic regions mitigates risk and increases opportunities for growth. Asset allocation is crucial for building a balanced investment portfolio. Here are several strategies to consider. Risk tolerance assessment. Determine your risk tolerance before allocating assets. This helps you understand how much volatility you can endure and guides your allocation decisions. Diversification. Spread your investments across different asset classes, stocks, bonds, real estate, commodities, to minimize risk. Each class behaves differently under various market conditions, so diversification helps balance losses and gains. Age-based allocation. The 100 minus your age rule suggests that younger investors can take on more risk because they have time to recover from market downturns. As you age, gradually shift towards more conservative investments. Asset rebalancing. Regularly review and rebalance your portfolio to maintain your desired asset allocation. Market fluctuations can skew your allocation, so rebalancing ensures it stays aligned with your goals. Market conditions. Consider market conditions and economic trends when allocating assets. For instance, during a bear market, you might lean more towards defensive assets like bonds or cash. Long-term goals align your asset allocation with your financial goals. If you're saving for retirement, you might allocate more to long-term growth assets. Short-term goals might require more conservative investments. Factor-based allocation. Some investors use factors like value, size, momentum, or low volatility to guide their asset allocation. These strategies involve selecting assets based on their specific characteristics rather than just their class. Tax considerations factor in tax implications when allocating assets. Certain assets, like municipal bonds, might offer tax advantages, so allocating them in taxable accounts could be more beneficial. Professional advice. Seek advice from financial advisors or professionals who can assess your situation and suggest appropriate asset allocations based on your objectives and risk tolerance. Remember, there's no one-size-fits-all strategy for asset allocation. It's essential to continuously assess your financial situation, adjust based on changes in your life or the market, and stay informed about the assets you invest in. Factors influencing asset allocation. Investment goals. Whether it's wealth accumulation, income generation, or capital preservation, goals heavily influence asset allocation. Time horizon. The length of time an investor plans to hold investments determines the appropriate mix of assets. Market conditions. Economic conditions, interest rates, and market trends impact the performance of different asset classes, influencing allocation decisions. Asset allocation. The distribution of investments across different asset classes is influenced by several factors. Investment goals and time horizon. The specific objectives you have for your investments, like growth, income, or preservation, and the time frame in which you aim to achieve them play a significant role in determining asset allocation. Risk tolerance. Your comfort level with market fluctuations and potential losses impacts the mix of assets in your portfolio. Higher risk tolerance might lead to a higher allocation in equities or alternative investments, while lower risk tolerance might favor more conservative options like bonds or cash. Market conditions. Economic trends, interest rates, inflation, and market volatility can influence the performance of different asset classes. Adjustments in allocation might be made based on current market conditions. Diversification. Spreading investments across various assets reduces the overall risk. Correlation between assets also plays a role in diversification decisions. Age and life stage. Younger investors might lean towards more aggressive allocations to take advantage of long-term growth opportunities, while older investors may prefer more conservative allocations to protect their capital. Tax considerations. Tax implications of different assets can impact allocation decisions. For instance, investments held in tax-advantaged accounts versus taxable accounts might affect the allocation strategy. Market valuations. At times, certain asset classes might be overvalued or undervalued relative to historical norms, influencing allocation decisions. Regulatory and policy changes. Changes in regulations or government policies can affect specific sectors or asset classes, prompting adjustments in allocation to mitigate risks or capitalize on new opportunities. Global events. Geopolitical events, natural disasters, or other global occurrences can impact markets and influence asset allocation strategies. Liquidity needs. Immediate or short-term liquidity requirements may necessitate a certain allocation to assets that can be quickly converted to cash without significant loss. Balancing these factors is key to creating a diversified portfolio that aligns with an investor's risk tolerance and financial goals. Regular review and adjustments to asset allocation are often necessary to maintain alignment with evolving circumstances and objectives. Rebalancing and monitoring. Regularly reviewing and rebalancing your portfolio is crucial to maintain the desired asset allocation. Changes in market conditions or personal circumstances may require adjustments to keep the allocation aligned with your goals and risk tolerance. Mastering the art of asset allocation is fundamental to successful investing. By understanding your goals, risk tolerance, and the various strategies available, you can create a well-balanced portfolio that withstands market fluctuations and moves you closer to financial success. Thank you for joining us today. Don't forget to like, share, and subscribe for more valuable insights into the world of finance and investing.